Welcome once again to one of my tutorial classes. This is about hedging. It has been requested several times and I have done a few simpler ones with the Gamma Optimizer, but the idea of this class is to provide a more in-depth presentation of hedging. So for that, we need to explore the basics, the connection to mathematics, and also the subtitle is why only a few of us should ever hedge. You will see why not everyone should hedge. I guess most retail traders should not hedge. That's kind of the takeout of this class. So the main points is I'm going to introduce the concept of risk, show you a little bit of portfolio theory, and then with that, I will reveal what is the true purpose of hedging. I guess most of you think that hedging is done just to protect against a downside that is going to happen. But that's not quite the true purpose of hedging. Hedging has a more mathematical purpose, a more finance-oriented mathematical purpose. So hopefully you will get it from this presentation. And also, there is no such thing as a perfect hedge. And this class will try to hammer that point that there are no perfect hedges, they don't exist. And finally, like after all this discussion, I'm going to devote a little bit of time talking about options and hedging. So if you're an expert in portfolio theory and you're an expert on risk assessments and risk modeling, then you could skip half of this presentation and move directly towards the options portion of it. So before even starting, let's review a little bit of the terminology, the basic lingo that we are going to use for this presentation. And here it is. The first is returns. I speak of returns all the time, and when I pronounce returns, when I say the words returns, I am actually referring to log returns. Log return is a quantity that is used the logarithm of final value divided by an initial value. So if you want to see the return of any investment, just do that. You know, what was the final value of the investment right now? What was the initial value? Do the division, take the logarithm, and that's the log return. That's what it is. And it can be done for any period, for 1 day, for 1 year. No, so usually I speak about returns, and usually I speak about daily log returns. No? One of the reasons we prefer log returns over any other ways of computing returns is that when you add them, when you add several log returns in a period, what you get is the true return of that period. That only happens with log returns. And for that, you just review properties of logarithms and review concepts like geometric returns, things like that. But that's the reason that in quantitative finance, log returns are preferred over normal ones. A very important concept that is connected with log returns also is volatility. Volatility is just the standard deviation of those log returns. If you have a series of log returns, for instance, a whole year of daily ones, like 252 of them, then if you compute the standard deviation of that series, that's the volatility. And the volatility is a very important concept because in the field of finance and in quantitative finance, volatility is risk. And that's kind of like a revelation for some of you, but that's how it's treated. It's a simplification, but it's very accurate. When we talk about risk, we talk about volatility. So when we have an asset that is very volatile, like for instance, Bitcoin, like the crazy stuff going on with cryptocurrencies, Bitcoin is very volatile. If you compute the standard deviations or log returns for Bitcoin, you will get a gigantic value of volatility, which implies that Bitcoin is a very risky product. Conversely, if you do something like you compute the implied volatility, the volatility of, for instance, a currency pair like dollars, USD, euros, like that one, the euro USD pair. If you compute the volatility of the standard deviation, the log returns for that kind of pair, you will notice that it's very small. So it has less volatility. And so forth and so on. You can compute the volatility of all sorts of asset classes or securities, and you can derive a measure of risk based on that value. The higher the volatility, the higher the risk. So those are some basic concepts, and tying them with a portfolio here or a strategy. Like when we speak about performance, people tend to only show you the total performance, the annual return of the fund, of the annual return of the strategy, but no one talks about risk, and risk is a very important thing. For instance, in this example, I have two strategies that deliver very similar returns. One strategy delivers, both of them deliver 15%, but notice the volatility. The volatility of one of the strategies is only 12%, and the volatility of the other strategy is 75%. And if I ask you to pick one, what will you choose? What will be your choice of a strategy if all things equal? Well, the reasonable answer, the sane answer, is to say that you will pick the strategy with less volatility. Why? Because less volatility means less risk. So you notice here I'm introducing a couple of concepts here. I'm introducing the concept of risk and volatility as risk, and also the concept of volatility as part of the performance. Not only you want good returns, in this case the same, but also you want lower volatility. So because of that, then the financial industry developed all sorts of tools, and one of those tools is called the Sharpe ratio. The Sharpe ratio is a good way to quantify risk and returns. No? So the Sharpe ratio is just a very simple equation, is the expected value of the excess returns of your strategy or fund or collection of assets divided by the standard deviation of returns, which we agree that the standard deviation is the volatility, and also we agree that is the risk. So this is a very interesting ratio, because imagine that the Sharpe ratio is, just for a second, imagine that it's less than 1.0. So it's less than 1. So what does it mean for this thing to be less than 1? It means that the volatility of your strategy, of the volatility of your fund, is higher than the excess return. And so that's what a Sharpe ratio less than 1.0 means, and of course it's terrible. So in the scale of things is this ratio between 0 and 1. If you have a fund or a strategy that has a Sharpe ratio of less than 1, we can say objectively that it's a terrible strategy, that you don't do it, because you're getting some returns, but you are risking a lot of money. So there is no point on doing that. There is no point on investing on that thing. Now, if Sharpe ratio is 1, that means that the excess return is equal to the standard deviation. That's kind of like not good. No, 1.0 is like, man, you're risking so much money and you're getting lots of drawdowns almost on the same amount of what you're risking, of what you're getting. So that's kind of not an ideal situation either. So of course, once the Sharpe ratio starts becoming higher than 1, then it kind of works, no? Because now you're getting more returns than the standard deviation. So a fund that delivers a Sharpe ratio, for instance, of 2 or more than 2 is a very good fund, very excellent fund. If it delivers 3 or more, then it's fantastic. No, if someone comes to you and shows you an investment strategy that has a Sharpe ratio that is very high, like 4, then that's it. That's the thing where you have to put your money. The higher the Sharpe ratio, the better. The expected value can be written as the mean. So it's actually the formula. Easier formula is just the mean of the excess returns divided by the standard deviation of returns. And by excess return, I mean the returns in excess of what? In excess of the risk-free rate. Because there is such thing as a free risk return. For instance, some people think that the United States Treasuries are the risk-free. So yeah, if you can get something that gives you excess return, is any return in excess of that rate, whatever the rate is right now, which I bet is very close to 0. It's a very small return. So that's the Sharpe ratio for you. It's a good way to connect risk and returns. So we'll come to hedging finally. What is the point of hedging? And how it connects with risk and how it connects with the Sharpe ratio? Well, hedging is the art of improving the Sharpe ratio. That's what it is. If you see hedging in a professional environment, either because they know it or not, if they don't know it, the only thing they are doing is improving their Sharpe ratio, because the whole point of hedging is to reduce volatility. To reduce volatility of what? To reduce the volatility of my portfolio. And by reducing the volatility of my portfolio, I am increasing the Sharpe ratio. And by increasing the Sharpe ratio, my strategy or my fund is more attractive. It's going to have more customers. It's going to have more investors. So it will look even better on the prospectus. So that's what is done at a professional level. I am reducing, smoothing the volatility of my portfolio by hedging. For instance, if I discover magically a strategy that cuts my half in risk, so volatility is reduced in half, and it costs me just a little bit, it costs me just 10% of my returns, so it has a very small impact on the total returns. So if I can do that, if I can find that magical hedging strategy which is cheap and it also dramatically reduces my volatility, the Sharpe ratio of my fund or my strategy improves by 80%, which is a very good improvement. Now, if for instance, if the Sharpe ratio was 1, then it becomes 1.8 right now. It's a fantastic improvement on the Sharpe ratio for doing that. And that's the whole point of hedging. That's the whole point. Hedging is not done to protect about like a future downside. It's just done to protect against, to try to reduce volatility. Then we arrive to here, to the holy grail of investing. What is the holy grail? Well, the holy grail is to develop any strategy that has zero risk and that has a return that is in excess of the risk-free return. So if you can find this combination and a strategy that doesn't have any risk, what does it mean? It means zero volatility, no volatility at all, and higher returns that are risk-free, then you just found the holy grail of investment, and you will become a very wealthy person, because you can put all of your money there in that strategy and it will grow steadily. It will grow and you will become a billionaire. No? The thing is, it is impossible to attain in practice. There is no way you can attain this. The risk-free, this holy grail is impossible to attain, and if someone says that he has it, then don't believe them, because it doesn't exist. However, that being said, there are a few market participants that engage in a trading strategy called arbitrage. Pure arbitrage is really close to the holy grail, because in theory, arbitrage is a risk-free trade, no? But in practice, there is always risk to trades. But however, these guys, the guys that are engaged in arbitrage are almost getting risk-free, not quite, but I mean very low risk, and those guys are really important to a market. No, like the more people engage in arbitrage, the more efficient the market becomes. No, so for instance, U.S. equity markets are highly efficient because of the tremendous amount of arbitrage that is going on. I guess it's like is a market that is fully arbitrage. Everyone is taking advantage of arbitrage in all sorts of areas. So the more arbitrage you have, the more efficient the market is. So it's a signature. But sadly, it's not for retail investors. These kind of trading strategies are not available to retail, and it's not also, I'm not going to talk about arbitrage. Maybe in a different lessons I can explain the strategies, but just for curiosity, because there is no way any of us can do them. So anyway, so the holy grail connects with the perfect hedge. The perfect hedge is anything that reduces risk to zero. So if you have a portfolio with certain volatility and you can find something that removes volatility, that's the perfect hedge. Does it exist? Well, the short answer is no, it doesn't exist. However, it does. Maybe in non-practical ways it exists. The easiest way to have a perfect hedge, for instance, is to liquidate your portfolio. If you are concerned about future downside, about a future drawdown, like a wave down, if we use the link of the Elliott wave trading Fox, then just reduce it. If you're so certain about it, just liquidate your portfolio, and then after the fall, come back into it. No, that's the perfect hedge. You will not lose a single dime. However, that's not practical. No, there is no practical for you to sell all of your shares. There could be tax considerations to it. There could be cost considerations related to commissions, or there could be just legal considerations. No. like it's against your charter, or you are restricted by law for the sale. No, so things like that. So there is no way to have a perfect hedge. There is a second way that is very mathematical that I'll talk about it in a bit. But again, the fact that it exists mathematically doesn't mean that it can be exploited in real life. The implication, the takeaway for you as a retail trader and investor is that the best hedge is not having a position. That's the best hedge. And just keep it in your mind whenever you are if you feel desperate for a perfect hedge, it's a great sign that what you need to do is to trim or liquidate your position. Now let's talk about portfolio risk. And let's talk about a portfolio. Now, portfolio is just a collection of securities or assets. No, you have a collection of these assets, and that's your portfolio. And the whole thing is evaluate the risk of the thing. You could evaluate the risk of every individual asset because it's very simple. You compute the implied volatility of each one, and that's the risk of each one. But in a portfolio, it becomes a little more convoluted to do so. So for example, I have a portfolio that is made of two securities and two stocks. Both of them return 10%. Both of them have exactly the same volatility, 10%. Therefore, both of them have the same Sharpe ratio. And the portfolio is equally weighted. I have exactly the same amount of like 50% of shares of security A and 50% of shares of security B. So the portfolio, we are equally invested. And now the question is, okay, well, let's compute the totals. If this is my portfolio, what is the total return? And what is the total volatility? And because of that, if you know those two things, you can compute the total Sharpe ratio of my portfolio, no? So some of you will say, oh, the return is very simple. The return is just adding these two things equally weighted, and the volatility is the same thing, and the Sharpe ratio is the same thing. So you will, like the naive answer to the question is, oh yeah, the total return will be 10, the total volatility is 10, and the total Sharpe is 10. However, that's not the answer. The answer is not correct. The total return is indeed 10% because it's easy. No, the total return of the portfolio is very easy to compute. It's just, as you imagine, is the weighted average of these things, and it's 10%. But the total volatility of the portfolio is not that. You cannot average volatility like that. You cannot do that. So we cannot compute it. We can actually not compute the total volatility of the portfolio from the data that I just gave you. I just gave you this data. From this data, I cannot do it. We need a very important piece of information. What we're missing here is something called the covariance matrix. We just need to find what is the covariance between security A and security B. What is the covariance? The name doesn't sound familiar. Maybe if you took statistics in college, you might remember it. But for most of you, the most familiar name will be correlation. No? So what we need is the correlation between these two assets. And what is the correlation? So the correlation is just a scale of the covariance. No? So covariance in general is just a statistical concept that links two different distributions. If you have two distributions of prices or log returns or whatever, it just links them, like how linked they are. Because in correlation form is a scale is very simple to understand, because in correlation form, covariance is expressed in a value that moves between minus 1.0 to 1.0. So that's correlation. Correlation kind of moves between the two extremes. And understanding correlation is very simple. For instance, a correlation of 1.0 means that the two assets or two securities or two whatever things move in lockstep. They really move together. If one goes up, the other one also goes up. If one comes down, the also comes down. An example, for instance, is the XPX and the Dow Jones Industrials. No? The correlation is close to 1.0. It's like 0.90 something. It's like really close to 1.0. And you see it. You see that these two markets, the S&P 500 and the Dow Jones Industrials, almost move in tandem all the time. So that's a positive correlation. A correlation of minus 1.0 means they move in opposite directions. If something goes up, the other one goes down, and it's kind of the perfect opposite. And an example of that is like SPX and VIX. The correlation between those two is almost minus 1.0. It's not quite minus 1.0, it's like minus 0.97, something like that. If the market falls, VIX goes up, and if market goes up, VIX goes down. That's kind of the correlation between the two. And that's what we are missing to compute the total risk. We are missing the correlation between these two securities. Now, we can see that that correlation is very important, and it also will take us a step closer to the second way of achieving the Holy Grail. So this is the example. This is the mathematical example I talk about. If you can find a security, like let's say a security that has perfect negative correlation, like the correlate is perfectly negative correlated, and they have volatilities that are very similar, then the total risk of that portfolio becomes zero. If you can do that, let's say you have shares of whatever, like, I don't know, some Apple, and if you can find a security that has a perfect negative correlation with Apple, I'm talking about perfect negative correlation, then you can reduce the total risk of the portfolio to zero. It's just like that. You know, I'm not making this up. It's just parts of mathematics. The reason is because if like imagine in this case the security A and security B have that perfect correlation. I don't even know what they are, but they have a perfect negative correlation. Then the total return will be 10, but if you compute the volatility, will be 0. And that's the Holy Grail. That portfolio will have no volatility, will have no risk whatsoever. And I just type the formula for just two. I mean, this isn't really a covariance matrix, so you can have like hundreds of shares, but for two, this formula is very simple. It looks very simple, like a Newton expansion of the square, like a plus b squared. So it's just the square of the volatility is 2 times the product of the volatilities times the correlation. So it's kind of a simple formula, and from this formula you can see if the correlation is minus 1.0, it kind of cancels everything. So that's how it works, and that's what is 0. And you of course you have a Sharpe ratio of infinite. So yeah, so I mean, technically, theoretically, it could be possible. You could find an asset with perfect negative correlation, but you will see the implications in real life of that, and why then you cannot become a billionaire by doing that. But it is there. I just present it. And it arrives. Then after this, we arrive to the meat of this of my point I want to drive, is that the siren song of perfect hedging. So people are obsessed with a perfect hedge. Like, I don't know why. Like, everyone is obsessed with that perfect hedge. Everyone is obsessed with the Holy Grail. But the reality is that investing and trading is a risky proposition. And that's why you're being compensated. I mean, you're being compensated for taking risk. If you remove the risk, why would you expect compensation? No? That will be the universe will not provide for that. So it is unattainable. And perfect hedging connects with that. It is unattainable. Don't look for it. Don't look for a perfect hedge, because it doesn't exist. Don't even waste your time, folks. And I know you ask me on the room for hedging, and in your minds you're actually thinking for a perfect hedge. But perfect hedges don't exist. However, no, it's unattainable for most people. You know, like I would say for almost all of us, perfect hedging is impossible, that kind of thing. But that being said, we can actually reduce the risk of our portfolio by doing several things. If what you want to is not engage in perfect hedging, but what you want to is to reduce the risk of your portfolio in general, yes, it can be done, and I can teach you several ways of doing it. But just be mindful of that. Now, be mindful that there are no perfect hedges. So let's see the ways of reducing risk in a portfolio. The first way, it sounds trite. It sounds like something that everyone says, but there is a truth to this. Diversifying. Yes, diversifying works, and it works really well. And there are reasons for why diversifying works, and there are mathematical reasons. And what is the point of diversification? So the point of diversification is to have a portfolio composed of assets that have really little correlation to each other. If you can find assets with no correlation to each other, you can reduce the risk of your portfolio dramatically. And just to illustrate the point, just look at the the same example portfolio that is made of two securities. If I pick two shares, security A and security B, and the correlation between the two of them is 0, so they have no correlation whatsoever, they are completely uncorrelated, look at the total volatility of the portfolio. The total volatility of the portfolio becomes 7%, 7.1 rounded. So it came down from 10% to 7%. That is a fantastic way of reducing volatility. And the good thing is, if you keep finding more and more, I mean, this is a portfolio with 2. If you can do it with 3, volatility gets reduced even more to 6. And if you have like an infinite amount of uncorrelating assets, you could also reduce risk to 0. No, but it's impractical. But if you have a big enough set of uncorrelated assets, then your risk will be incredibly low. In practice, that's almost impossible to find. However, that's one of the reasons why bonds are recommended in a good portfolio. A mixture of bonds is recommended because, in theory, theoretically, and also in practice, there is no correlation between bonds and stocks. The correlation between bonds and stocks is almost 0. No, not quite 0, but it's very close to 0. So by adding bonds to your portfolio, you are reducing the total risk, and that's a trick. And when people recommend bonds for your portfolio, that's why they are doing it. It's not because they are old school or old fashioned or anything. It's just because those are uncorrelated assets, and you want to have an uncorrelated asset in your portfolio in order to reduce total risk. Well, uncorrelated assets are hard to find. I just gave an example, bonds, but other than bonds, it's kind of like, man, what can I find that it really is uncorrelated to the current one? So the answer is, it doesn't matter. Even if there is correlation by just properties of the square roots, something that goes back to the Pythagoras theorem, correlation, the total risk will come down. For instance, so we have the same portfolio with the two securities, and they actually have a correlation, and actually a high correlation, 0.7. For instance, they could be, for instance, Apple and Google, or it could be Facebook and Google, something like that, something with really high correlation. But look, it's not 1. Is less than 1. And if you compute the total volatility of your portfolio, if you develop the formula, it is 9.22%. Risk is reduced. Just like that. Just by adding a security that doesn't have perfect correlation, risk is reduced. And this is only a portfolio with 2. If you keep adding more, 3, 4, 5, all the way to 500, then the total volatility will be incredibly reduced. That's the whole point of diversification. The whole point of diversification is to reduce the volatility of your portfolio without impacting your returns. And if you keep adding, as I mentioned, the risk will be reduced even more. Okay, so we arrive at the point of assets with negative correlation. That's a good question. We examine what happens if I can find an asset that has no correlation to my portfolio. What happens if I have an asset that has high correlation but not quite 1. And now what happens if I find an asset with negative correlation? Well, we saw that that's kind of the holy grail. But it doesn't have to be perfect negative 1.0. It could be like negative 0.5 or whatever. And yes, it works. But the only problem with negative correlated assets is, by definition, then if your portfolio has a good year, those assets are going to have a terrible year, no? So the returns of negative correlated assets will have the opposite sign of my returns. And that's kind of like sad. I mean, that's why we cannot attain the Holy Grail, because there is no such thing as negative correlation and also positive returns if I am having positive returns, no? You see my point? So, what do we do? What do we do with this thing? Well, we could use them. If I have an asset with negative correlation, I could use it in my portfolio. For instance, I could pick one that is really volatile, has high negative volatility, and I can use a little small weight, so that way it doesn't eat into my returns that much, just a little bit of my portfolio, and it will reduce the risk. Just by that, by virtue of that, risk will be reduced by using that negative asset, because it has high volatility and is in a small weight. And this is one of the reasons why precious metals are added to portfolios. I mean, there are many reasons, but one of the reasons that a portfolio they recommend to have metals on it is because of the quote unquote negative correlation with the stocks. Like we used to have that. I don't know what is going on with gold lately, that it has had periods of positive correlation, but in general, in the long term, it tends to have negative, and it's a good way to have it because it's a good way to also smooth out risk, smooth out volatility in my portfolio. And so, just this is just a curiosity right here that I just dropped. Okay, now we are arriving to the meat of the class, and I say coffee break, but no, this was I was thinking of doing this class live, so I was thinking of having a coffee break. But no, let's continue. We can do it. We can continue, or you can pause here if you're watching on YouTube. You can pause here and drink some coffee. Then we get curious about this. We can see that negative correlation is kind of good to have, but the question is, can we have a nonlinear asset that has negative correlation? What is a nonlinear asset? A nonlinear asset is an asset that will deliver amazing gains and very small losses. That's kind of nonlinearity, no? So the problem with gold is kind of a linear asset. Precious metals are linear, so they deliver great gains, they will deliver great losses too. But with a nonlinear asset, I could exploit the best of both worlds, and then I could improve tremendously in my portfolio if I can find something like that. If I can have find a nonlinear asset with negative correlation, is kind of like, man, this is close to the Holy Grail. And then I pose the question to you folks that are watching this video: do that kind of assets exist? Do you know any asset that is nonlinear that can have negative correlation with my portfolio? Can you think about one or two examples? I will say that there are probably 3 different assets classes like that, but with 2 it's more than enough. And even if you only answer one, I'll be very happy. Just think about it. Ta-da! Yes, there is an asset like that. Options are nonlinear assets. If you have watched all of my YouTube videos, you'll notice that options are products that are non-linear, and if you know what kind of option to pick, you can find negative correlation. So that's it. Options are the perfect companion to portfolio hedging because they have the best features that we want, and they can be negative correlated to my portfolio. For instance, puts are negative correlated to any portfolio, and they are non-linear. Puts are also non-linear. They deliver really, if the market falls, or if your security falls, the puts will deliver really nice profits. But if your portfolio keeps going up, well, the puts will lose money. But what will be the max loss? The cost of the put is a very small loss. So that's kind of the perfect thing. So let's do the example. Let's imagine a security that the same security A that has 10% return, total volatility of 10% and Sharpe of 1. But now let's add one single put to this portfolio. So we have 100 shares of that security and we add one single put. And to make things simple, we add the money put. Just a note here, this is only for the purpose of the example, like don't hedge without the money puts. I'm just doing this so you can see what happens. So this is my sample portfolio. I have 100 shares and I have one at the money put. Then I'm going to, if you have this kind of portfolio, I can show you that the initial correlation between the two is minus 0.5. Is the initial correlation. I leave it as a homework for you, but it is minus 0.5. So we have negative correlation and we expect volatility to be lower. What about the return? Okay, well, the return will be affected, of course, because of the cost of the put. So we could model the portfolio. I could model the portfolio, but a full modeling of the portfolio will require a Monte Carlo simulation, no? Like a very full-blown complex simulation. I don't have the time to do it for this class. Also, it's of not interest to what we want to accomplish here. We want to just to see the consequences of having the put. So let's do the naive modeling. Naive modeling is easy because then I can ignore all the path dependency of this thing, and then let's focus what happens at expiration. So At expiration, imagine that the put is a leap, is an option that expires 12 months from now. So what happens at the end? What is the status of my portfolio? If the portfolio keeps moving up, I mean the market, my portfolio is the market just goes to the moon, the total return will be the return of my portfolio minus the cost of the put divided by the total size, I mean the percentage of the cost of the put. No? So if the put is cheap, then the impact on my profits will be small. No, if the cost of the put compared with the total size of the portfolio is small, then it could work. So you can see that yes, by using the puts, we are affecting the total return. However, the effect is constant. The effect is constant. The portfolio can go to the moon, yet the negative effect is the same. So it's a fixed reduction in return. Now, imagine the decline of the price of the asset. Let's imagine that 1 year from now, the asset is not at the current level, but is negative. We have a negative year. What is the total return? Well, it's a loss. We're going to lose money. But however, look at this. The loss is only the cost of the put. That's the only loss that we have incurred at the end of the period. So we have a fixed loss, which ideally should be small, no? And it doesn't matter if there is a major crash in the market. It really doesn't matter. It doesn't matter if an asteroid hits there. I mean, from the point of view of the analysis, and the whole market goes to zero. It doesn't matter because the only loss I have in my portfolio is a fixed loss, which is the cost of the put. And if it's a small, it should be a small loss. So this is like even the naive modeling is showing me, which is kind of the extreme. Now the naive modeling is showing you the extremes. It's not showing you all the values in between. But on the extremes are actually really good. The extreme loss is the cost of the put, and the extreme gain is the return minus the cost of the put. And both of those things are fixed quantities and ideally small. So right there, you can see that a nonlinear security and a nonlinear product like options is perfect for hedging portfolios. And I just gave you like the most, like, let's say, naive way of doing it, instead of saying a stupid way of doing it. And the thing is that you don't want to use the money puts because they are very expensive. So they will eat into your profits. It will be a cost on your profits, unless those are XPX puts. Right now they are incredibly cheap. Now, so you have to look at the markets and see if the puts are cheap and if the puts will eat less than the expected return on your portfolio. Okay, so that's it. The cost of the put is critical. That's one of the most important things. Because you don't want the cost of the put to be 10% of your portfolio, because if it's 10%, then that's it. It doesn't work. Like, how much does the market goes up in 1 year? No. In a typical year, the market can go up 10%, and you are paying it already in the put of, yes, you're protecting against a crash, but at the same time, you are eating all of your profits in the protection. So that's not ideal. And that's what I'm expressing here. Like, in real life, are pretty expensive, and the effect in total return is actually very significant. But with this, we can look at some ideas. And this is actually a class, no? And I am sorry I took so long to arrive to this point, but I really wanted to give you like a nice background of what we are doing here. Okay, so we can use options to do two types of hedging. We can do what I will call drawdown insurance. So you want to hedge to protect against an expected drawdown. For some reason, you have a crystal ball, and you can guess that with high probability that there is going to be a fall on your particular market. I don't know, gold or shares, or like your full portfolio S&P 500 is going to provide that. So what do? You protect with puts, no? And with a single puts, that's the only thing. You buy puts. Don't buy the at-the-money put, of course, because the at-the-money put will try to protect against any fall. You have to find the put that will cover the expected downside that you have, no? And it will be an out-of-the-money put. It's not that far. It will be substantially cheaper than the at-the-money, and it will be a good way to protect. And if you ask me how you find those kind of puts for drawdown insurance, and I'll answer with the gamma optimizer. The gamma optimizer will find those for you, and there are videos. There is one video where I explain how to find that particular put. So, but there are other considerations, but I will say that in general, that's how you do it. And this is only drawdown insurance. Drawdown is like a small downside. Drawdown for me is like 2 to 5% fall. Now, like if you should not go broke with that kind of falls. If you are going broke with a 5% drawdown, then there is something wrong with your portfolio, my friend. No, you are either heavily leveraged or something is wrong. So it is, I will personally never hedge for drawdown, but I know you guys love to do it. So use the gamma optimizer. No, the gamma optimizer can be a good way to do drawdown insurance. Then we have catastrophic insurance. This one I will do, and I will do all the time. No. Catastrophic insurance is something you really want to protect your portfolio against a black swan. And this deserves protection. A black swan deserves protection because first, no one knows when it will happen. You have no idea when it will happen. Second, when it happens, you could be subject to forced liquidation. You could be subject to a margin call, or you will be forced to raise liquidity because some customers want to redeem shares on your fund, or they want to pull the money out of your whatever investment vehicle, and then you have to raise liquidity when there is no liquidity in the market, when prices are terrible. So you don't want to do that. So you want to protect against a black swan, and for that the way of hedging is very peculiar, because the way to hedge against a black swan is finding puts for an index. I don't care if your portfolio only has Tesla and Apple. You don't buy puts for Tesla and Apple. You don't do that. I mean, it makes no sense. What you buy for this catastrophic insurance are index puts. That's what you do. Because during a drawdown, during a black swan event, the correlations of every asset in the planet becomes 1. Exactly 1.0. And when that happens, then it really doesn't matter if you are buying the puts on the individual shares or if you are buying the puts on the market. But the puts for the market are incredibly cheaper compared with the puts for your shares. So catastrophic insurance is all about buying index puts. And the move down is massive. We are talking about 20% or more. If you want to be conservative, you can protect against 10%. But I will say, anything higher than 10% is catastrophic insurance. And the protection is very cheap, it's very efficient, and again, who will have guessed it? The gamma optimizer can be used to find those too. I could do a video, very specific video of how to use the gamma optimizer. There is one, but if you have doubts or maybe something is not clear on that video, I can do another one. Just ask me, just request it. Okay, so this comes to something different that it is not related to drawdown. Well, it might be related to drawdown, but it's called protective collars. This I will do. I will do a protective collar from time to time. What is a protective collar? A protective collar is a situation that is very common because we want to protect against downside, but we don't want to pay the full cost of the puts. We really don't. Puts, at the end of the day, puts are actually expensive if you think about it. So the question is, are there ways to finance those puts? And the answer is yes. Really, there are ways. For instance, the only thing you have to do is buy the put, and you can find the put with the gamma optimizer, whatever, you just do it. But at the same time you're buying a put, you're also selling a call. And the call is an out-of-the-money call. And the idea is that is out-of-the-money kind of your expected profit on your portfolio. Let's say you expect your portfolio to appreciate at least 10% this year. So if you want to do that, you can design a protective collar by buying a put for the expected drawdown and selling the call that is around 10%. And that's it. So your portfolio, as long as your portfolio is below the call, is still delivering profits, and the money you got from selling the calls are used to buy the puts. And because everything is against the shares you already hold, then you are not subject to margin. No, that's like the perfect world. It's like paradise. A protective collar is actually paradise. The only drawback of a protective collar is that you are sacrificing future profits, depending on how far out of the money the call is. I mean, if you want to really get the puts for free, then you have to bring the calls really close to the money value, and so you're going to sacrifice a lot of profits. But it can be done. I mean, it is a good way to play drawdown moves, in particular if you think they are going to be near term, and in particular if you think they are going to be transient. You can establish a protective collar and then remove it once it is making tons of money, no? So that's a protective collar. And now I come to something that is more generic. What is the optimal hedging with options? So yes, you have a portfolio made of 2, 3, 4, 5, depending on your degree of sophistication and diversification, you can have a huge portfolio. So the recommendations in general, don't try to hedge every stock in your portfolio individually. Don't do it. I mean, it makes no sense. It really makes no sense. Unless you are doing like an ETF or an asset class that has no correlation with the SPX. For instance, you have a volatility product in your portfolio, or you have like a precious metal thing like GDX of GLD in your portfolio. Those are required to be hedged individually. But if you have stocks, shares like Tesla, Facebook, Bank of America, something like that, then if you want to hedge the whole thing. Hedge the full portfolio. Don't hedge individual stocks. Why? Because of something that is called dispersion. Dispersion is a well-known phenomena, which is, I mentioned it, is because the correlation between the assets is not perfectly 1.0. So asset correlation is not 1.0, then there is dispersion with the index. So an index like the S&P 500 is made of 500 stocks, about, more or less. And the volatility of S&P 500 is substantially lower than any volatility of the constituents. And that's the effect of dispersion, because the constituents don't have pure 1.0 correlation with SPX. They have 0.5, 0.6. They are correlated, but not quite 1. So that also means that options in index are cheaper than options on the individual components. And that's a truth, this has always been truth. You can find cheaper puts in SPX than the puts for any other individual stock. So when you hedge, doesn't matter if you're hedging a drawdown, doesn't matter if you're hedging with a protective collar, just hedge the full portfolio with the puts. No? Now, for a protective collar, then yes, use the put of the index, but when you sell the calls, sell the expensive calls. And what are the expensive calls? The expensive calls are in the stocks. So you buy puts in XPX, but you sell calls on the stocks. You see, that's the optimal way to do. But then you have a little problem. The problem that you have is that SPX has 500 stocks and your portfolio has 5. No? How you do that? How you scale between those two? No? And how do you know how many puts in XPX do you need and things like that? No? So that comes to the concept of beta and portfolio modeling. So if we could model the portfolio, the 5 and 4, as a function of the XPX, then it is easy to find the puts that will model. But for that, I will save that for a different class. I will say like the full nuances of portfolio modeling. I will save them, but in general, in this class I wanted to give you the general views and the options that you have to hedge with options, and how to use the gamma optimizer for that. I mean, you can check the other video, and I will create a class shortly about the concept of beta and how to use beta for your stocks as a way to model your portfolio and come up with a equivalent position inputs in SPX. So folks, thank you very much. I don't know how long this thing is. I just recorded it in one shot. and I have no idea what the duration is. I hope it's not too long. 49 minutes. I apologize about that. And just think about the concepts. Please type all of your questions in the thread in the Gamma Optimizer room. I'll answer all of them, and I will start producing the second part, which will be substantially shorter. Like beta and portfolio modeling is like incredibly short. It's only a fancy name. It's a very simple concept. So thank you again. I hope you had fun with this, and let me know all of your questions. Take care.